Assalamualaikum and good day to Doctor. We are from Group 2 would like to present about the Madoff accounting scandal. Next, I would like to introduce our team members. First one, Nur Fazana binti Ahmad Tamizi. Secondly, Muhammad Azim Aizuddin bin Muhammad Jasmine. Thirdly, Munirah Amani binti Azimat. Lastly, Yap Zimi.
Bernie Madoff, a former American stockbroker and investment advisor. It is infamous for orchestrating the largest Ponzi scam in history. He founded Bernard L. Madoff Investment Securities in the 1990s, initially running it legitimately and building a reputable image. However, in December 2008, Madoff confessed to his son that his investment management was a massive Ponzi scam.
Firstly, transparency. Madoff firm present limited disclosure regarding the essential information of its actual financial performance. This secrecy prevent auditors from understanding how the company supposedly generate high returns. They were unable to analyze the inherent risks. Thus, we can see the audit quality of the company financial statement was seriously compromised by the absence of transparency. Next, over-reliance on management representation. Investors were drawn to Bernie Madoff investment firm especially because of his past performance. This will cause pressure on the auditors to maintain Madoff firm perception as a legitimate investment firm, as Madoff positioned himself as a reputable name in the investment industry. Auditors may have taken their consistent return and excellent records as an evidence of acceptable financial statement. Professional competence. The complicated process of split strike conviction combined with Madoff and his firm fraud made it impossible for auditors to gain a full understanding of the matters along with their risks. Without any extensive knowledge about complicated investment, auditors were incapable of accurately assessing the reasonable of state returns or discovering any red flags conveyed in the financial statement.
Professional skepticism. In Bernie Madoff case, F&H with only 3 employees, including David G. Freeling as the sole accountant auditor, were inadequate for the scale of Madoff operations. F&H failed to uncover the fraud, resulting in misleading audit reports about the substantial funds managed by Madoff. They did not conduct a thorough investigation or exercise reasonable assurance to detect the fraudulent activities at Bernard Madoff Investment Securities. Non-compliance of auditor independence. According to ISA 200, states that auditor must maintain independence during financial statements audits, ensuring objectivity and preventing conflicts of interest. David G. Freeling, the auditor for Bernard Madoff Investment Securities, admitted in court to continuing his audit relationship with Madoff, despite having significant financial investment with him, which is violating the professional standards. Assessment of internal control. Auditors are responsible for evaluating a company's internal control to prevent frauds, inherent risks, and misstatements in financial reports. In Bernie Madoff case, F&H failed to adequately test internal controls related to securities and investment transactions. These oversights allowed Madoff to manipulate controls and conduct his Ponzi scams.
The factor of Bernie Madoff and the solar auditor scandal, number one is regulatory oversight failure. The reliance on a solar auditor also exposed weaknesses in regulatory oversight. Regulatory bodies such as the Securities and Exchange Commission (SEC) failed to adequately scrutinize Madoff's operations and detect the fraud despite receiving numerous red flags and tips over the year. The SEC's failure to uncover the fraud highlighted gaps in regulatory oversight and the need for more robust measures to prevent financial fraud. Factor number 2 is limited resources and expertise. Solo auditors, especially small accounting firms like Freeling and Horowitz, often lack the resources, expertise, and manpower to conduct comprehensive audits of complex financial operations like Madoff. Madoff took advantage of this limitation by exploiting weaknesses in the audit process and manipulating financial records to perpetuate his fraudulent scheme. Next, the implication of Bernie Madoff and the solo auditor scandal. Implication number 1 is loss of trust. Madoff's Ponzi scheme destroyed public confidence in the financial sector and the authorities in charge of regulating it. The investors experienced catastrophic losses, especially those who had trusted Madoff company with their savings. This resulted in a general lack of confidence in the reliability of financial institutions and markets. Next, weaknesses in auditing practices. Significant flaws in auditing procedures were made clear by the Madoff case, most notably the risk associated with using loan auditors or tiny auditing firms with insufficient funding and experience. In order to identify and stop financial fraud, it emphasized the significance of strong auditing standards, exhaustive due diligence, and independence in auditing procedures.
So, for recommendation, we can use regulatory oversight. Regulatory bodies like SEC should enhance oversight by implementing strict auditors' rules, closely monitor financial institutions, and imposing harsh penalty on offenders to combat fraud effectively. Second, we can use audit quality. Auditing firms must invest in continuous education for auditors. This enables them to grasp completely financial issues and identify fraud indicators.